A while back, I made a video breaking down the S&P 500, taking a deep dive into it, and telling you about my views on what I think about investment in the S&P 500. Since then, a lot of you have asked me, hey, Niranjan, what about the European markets? What are your views on a European equivalent of the S&P 500? So I thought, let's make this one interesting. Let's compare the S&P 500 to its European equivalent, Europe versus the USA. Let's discuss this interesting question in today's video. Before we deep dive into this topic, if you haven't already watched my views on the S&P 500, I put a link up here. I suggest you go watch that. While there is nothing exactly like the S&P 500 in Europe, the closest thing that comes to my mind is the STOXX Europe 600. So what is the STOXX Europe 600? The STOXX Europe 600 is 600 of the largest publicly listed companies across 17 countries in Europe. These 600 companies cover roughly 90% of the market capitalization of all publicly listed companies in these countries. Now you may ask, how much money is this? Well, it's about 13 trillion euros. Now you're like, hey, trillions, how much is that? That sounds like a lot. So to give you some comparison, the S&P 500 covers roughly 40 trillion euros in market cap. So the S&P 500 covers more than 3 times the amount of market cap that the STOXX Europe 600 does. No. That's not what I'm saying. What I'm saying is the index, the S&P 500, covers a market cap that's 3 times the size of its European equivalent, or the closest European equivalent. The largest ETF that tracks the STOXX Europe 600, if you're living in Europe, is run by Amundi, with about 12 billion euros in assets. The good thing is it has a relatively low expense ratio of 0.07%. However, the problem with this one is it's an accumulating ETF. And typically, the problem with accumulating ETFs is they don't pay a dividend. I generally like that psychological comfort when I get a dividend, even if it's a small amount. So for me, I don't really like this ETF and I'm not going to go with it. There are distributing ETFs, so ETFs that do pay a dividend that are based on the STOXX Europe 600. However, the challenge with those is they have a higher expense ratio. Some even have an expense ratio of 0.2%. And on top of that, they're much smaller in size, which means the liquidity or your ability to buy and sell may be hampered. At this point, I'd like to tell you, if you haven't already subscribed, please hit that subscribe button. It does help the channel. Thank you. Well, let's evaluate that one. I'm now going to put a graph that you can see on your screen. As you can see from this graph, over the past 5 years, the STOXX 600 or the STOXX Europe 600 has returned about 46%. Now this graph from Google Finance shows you that if we compare it to the S&P 500, the S&P 500 in that same period has delivered about a 92% return. So double the return essentially in the same period. That's a massive difference. Now some of you may say, hey, Niranjan, but the STOXX Europe 600 is cheaper. The price to earnings ratio of the S&P 500 is around 28 today. The STOXX Europe 600 is around 16. So sure, some people may say, hey Niranjan, the STOXX Europe 16 is undervalued. I agree with that to some extent, but here's the catch. The S&P 500 is far more tech heavy than the STOXX Europe 600. What does that mean? People are willing to pay much more for $1 of profit with the S&P 500 compared to $1 of profit or €1 of profit with the STOXX Europe 600, simply because they believe that the S&P 500 has greater future earning potential, greater growth. And when I think about that, that's how I kind of justified even to myself, saying, hey, I'm willing to pay more for the S&P 500 because I believe there's a greater growth story going on there. Does that mean the STOXX Europe 600 is all bad? No, I wouldn't say that. Well, at least not yet. Let's analyze a few more things. Let's look at the top 10 holdings of each of these indices. What you can see in the graph next to me here is that in the S&P 500, 9 out of the 10 companies are in the field of technology or have something to do with technology. If we now look at the STOXX Europe 600, you can see that not a single company in the top 10 is in the field of technology. Even more interesting, the top 10 holdings of the STOXX Europe 600 only comprise or only make up about 16% of the overall index. Now, if we see the S&P 500, you'll see the top 10 holdings account for more than 38% of the entire index. Now, some in the Europe camp may say, hey, that means the S&P 500 is far more concentrated. Doesn't that mean we're undertaking higher risk? Well, that may be the case. But at the same time, with higher risk comes higher return. And while I understand some people may say, hey, Niranjan, I like a more conservative approach. European companies are more conservative. And I would say, hey, why not? I agree with that logic. Makes sense. But then in the long run, you may also have to expect more conservative returns. We'll discuss that a bit later in the video. Now, we've seen in the graph that I've just shown you that the S&P 500 has done far better than the STOXX Europe 600 over the last 5 years. And in the future, it may be totally different. So what I'd like to do now is to show you a 20-year history of a comparison between the STOXX Europe 600 and the S&P 500. If we look at this graph from Yahoo Finance, you can see that the STOXX Europe 600 initially did perform better than the S&P 500. However, if you look at it over the last 20 years, and this is a graph that I've charted from 2005, you can see that the STOXX Europe 600 has barely doubled an investor's money. The S&P 500, on the other hand, has returned 6 times, or almost 6 times the money invested. That's a massive gap. And in my opinion, I don't see that changing anytime in the near future. Well, for the first one, like I mentioned, I think tech dominance in the US has played a major role. Tech companies have a higher growth rate, have a higher earnings potential, and there's more interest also when it comes to clients and customers who are willing to buy those products, as well as from an investment community perspective. The second reason I feel American companies or companies in the S&P 500 have done better is because in the US, typically you have lower taxes, lower corporate taxes than in a lot of European countries. And it's not just about taxes on the corporate level. Even when it comes to income tax of individuals, Europe is known for very high taxes, very high social security costs, and it's very difficult to lay off workers. While I really hope all of us keep our jobs, it is a fact that a company tends to struggle when it's more difficult to lay off, let's say, workers that they don't need or workers that are underperforming. And in this aspect, Europe typically does lag behind the US and does tend to suffer more as a result of this. A third reason, and a reason that's often not talked about very much, is the fact that in the US, since the second half of the 20th century, there's been a culture of investing in retirement funds. You've quite often heard, even if you're living in Europe, about an IRA, a Roth IRA, a 401k. Now, what happens is because you have a lot of people who are living in the US investing in their own retirement funds, that further adds momentum to the stock market, to these tech stocks, and to the entire equity markets in the US. Europe, unfortunately, does not have a similar equivalent. Sure, you have some sovereign wealth funds like in Norway, but even if you look at the sovereign wealth fund in Norway, the amount of money they have is minuscule compared to the total amount of money that's there that the Americans have invested together. Let me give you some numbers. Over $25 trillion is held by Americans in retirement accounts. The Norwegian sovereign wealth fund doesn't even have 10% of this amount of money. And when it comes to other European countries, what are they doing? Well, not very much. What's happening in Europe? Basically, if you're working, you're paying for your parents' pension. So the government doesn't have any time to invest that money or to let it grow. The fourth reason is geopolitical instability. Europe has a war basically on its shores. The US does not have a war that's taking place in its own territory. This further adds to instability, supply chain issues in Europe, higher inflation than Europe expected, and all of this has hampered economic growth in Europe. I live in Europe. I believe in Europe. I like Europe. I like the quality of life we have here. But unfortunately, Europe may not be as good at doing certain things that its ally across the pond is doing. If we look at the returns of the S&P 500 compared to the STOXX Europe 600, you can clearly see there's a massive difference. If we also look at the composition of the STOXX Europe 600, it has no tech company in its top holdings. And I really wonder where the growth is going to come from those companies in Europe in the future. I fear the growth is going to be very limited, and it's going to be in the hands of just a few companies, and that's unfortunate. Now, one may argue that in the US as well, the growth is in the hands of a few companies. But if we look at the way those companies have grown, how they've helped the entire global system, the global ecosystem, it is something really that one can only stand and be amazed at. So would I never invest in the STOXX Europe 600? No, I didn't say that. But right now, I don't think it's the right moment. Perhaps when things change in the future, perhaps when European leaders have policies that are more business friendly, perhaps when we have companies here on European soil, tech companies or high growth companies or companies focused on AI that can actually add serious value to the economy, I would reconsider it. But for now, it's true, I would rather choose the S&P 500 and stick to that. What about you? Do you invest in the STOXX Europe 600 and the European ETFs? Or are you sticking to the S&P 500? Please do write that in the comments below. Thank you for watching, and do stay tuned for my next video.